Welcome back to the Deep Dive. It is Thursday, January 29th, 2026. And if you're tuning in right now, you are probably staring at your monitors, maybe on your second coffee, wondering why the markets just feel like they're holding their breath.
They absolutely are. It's a strange morning. We're sitting in this, this weird intersection of what the intelligence dossier is calling monetary stasis and institutional divergence.
Stasis and divergence.
It sounds technical, I know, but you can feel it on the charts. It's just tension.
It sounds like a bad sci-fi novel, but yeah, it's really just the bond market and the Bitcoin chart in a staring contest.
Pretty much. A tug of war where neither side wants to give an inch.
Okay, so our mission today is to unpack the institutional confidential briefing. It just dropped for the window ending 07.00 Central, and the vibe is it's distinct. It's not just about price. It feels like there's a real fracture in how the big money is moving.
There absolutely is a fracture. You have the Federal Reserve basically stepping back, Congress walking into a complete mess, and the ETF market splitting right down the middle.
Yeah.
It's messy.
So here's the docket. First, we need to talk about the Fed's new shutdown neutrality, which is basically Chair Powell telling Congress, you're on your own.
Yep.
Then we've got this fascinating split in the ETFs. BlackRock is selling, but Fidelity is buying. And we have to get into this procedural trap in the Senate that makes a government shutdown tomorrow look almost like a sure thing.
That's the ticking clock everyone's watching.
Exactly. And then some hidden corporate stuff, Tether making a fortune on gold, and some insider selling at CleanSpark that really makes you question their whole AI story.
It's a dense briefing today, a lot of moving parts.
Let's just dive right in. The
Yep.
Fed. Yesterday, January 28th, the FOMC decision. Rates held steady, 3.50 to 3.75%. On the surface, that's not a surprise, right?
The hold itself, no, not at all. The market had that priced in at like 99% certainty. Everyone knew they were going to sit on their hands. But if you actually scratch the surface and look at the vote, that consensus was kind of an illusion.
This was the aha moment for me in the notes. It wasn't unanimous.
Not even close. It was a 10-2 vote. We had two dissenters, Governors Stephen Mirren and Christopher Waller, who actually broke ranks. They wanted a cut.
They wanted a cut right now.
Yeah, they were pushing for 25 basis points immediately.
And Christopher Waller dissenting? I mean, that's not just some random governor. That's a signal.
It's a huge signal.
Yeah.
You have to remember, Waller is, widely seen as the leading contender to be the next chair of the Fed when Powell's term is up.
The heir apparent.
Exactly. So when the guy who might be running the show next year is openly dissenting against current policy, that sends a very specific message.
It tells you the center of gravity at the Fed might be shifting, even if the rate didn't move.
Precisely. It suggests that while the hawks are in charge right now, there's a powerful dovish undercurrent building. But, and this is the key for today, the market didn't rally on that. Usually a dovish dissent would plump Bitcoin. Yesterday, we actually sold off a bit.
Why? I mean, if the next guy in charge wants to cut, shouldn't risk assets be flying?
Because the market cares about liquidity today, not next year. It's an impatient beast. It doesn't care about Waller's vision for 2027. It cares about Friday. And that brings us to the most critical thing Powell said. We're calling it the Shutdown Neutrality Doctrine.
Okay, let's unpack this because this feels like a real shift. Government shutdown is looming for tomorrow. Normally, the market just assumes the Fed put is in play.
Right. The Fed put. That old assumption that if the economy stumbles, especially because of Washington's dysfunction, the Fed will just step in, inject liquidity, and save the day.
The ultimate safety net. But Powell basically just cut the ropes on that yesterday.
He did. He took a pair of scissors to it. He was asked about the shutdown, and he called the potential economic effects temporary and reversible.
Temporary and reversible. Wow, that sounds dismissive.
It's Fed speak for, we're not bailing you out. He's actively decoupling monetary policy from fiscal dysfunction. He's telling everyone, if the government shuts down, don't expect us to turn on the money printer to cushion the blow.
That is harsh. It's tough love from the central bank.
It's aggressive neutrality. And for an asset like Bitcoin, which, thrives on excess liquidity, this removes a critical safety net. We are staring at a potential liquidity shock, and the Fed just washed its hands of it.
And to make it worse, didn't he basically admit they're going to be flying blind if this happens?
He did. And this is the part that introduces what we call epistemic risk.
Okay, fancy term. Break that down.
It just means the risk of not knowing what you don't know. Powell acknowledged that a shutdown stops the data. The Bureau of Labor Statistics, Bureau of Economic Analysis, they go dark. So no jobs report, No CPI inflation data.
So the Fed is saying we'll make decisions based on data, but the data feed's about to be cut off.
Exactly. It's the blind pilot scenario. They're flying the plane, but the instrument panel is about to go black. The chance of a policy error, it just goes way up.
Right.
And markets hate uncertainty more than anything.
Okay, so the Fed's out of the picture, the data's going dark. Now let's look at how the big money is actually reacting to all this. You mentioned this fracture in the ETFs.
Right. It's been monolithic buying for months, everyone just piling in.
Mm-hmm.
But the data from yesterday, it shows a complete divergence.
Okay, hit me with the numbers. What does the tape show?
So the aggregate number, the headline you see everywhere, was a net outflow of about 19.6 million. Sounds, mildly bearish.
Sure, a small red day, nothing to panic about.
But when you look at the split, it tells a completely different story.
Yeah.
BlackRock's IBIT saw outflows of 14.2 million.
Okay.
But Fidelity's FBTC saw inflows of 19.45 million.
Whoa. So they're basically moving in opposite directions. That's rare.
It's very rare,
Yeah.
and we can infer a lot from that. BlackRock's IBIT, it's increasingly the proxy for fast money hedge funds, tactical traders, people who get in and out quickly. The fact that they're selling suggests they're de-risking ahead of the shutdown.
Taking profits, moving to cash, waiting it out.
Exactly. But Fidelity's client base is historically stickier. It's wealth management RIAs, people allocating for the long term. They saw the price dip, and they saw it as a buying opportunity.
So we're seeing a handoff. The fast money is getting out, and the long-term holders are stepping in to buy from them.
That is a perfect way to put it. And that handoff is why the price is just chopping around this $88,000 to $90,000 zone. It feels stuck because you have two huge forces pushing in opposite directions.
But the interesting thing is the money leaving Bitcoin. It's not really leaving crypto, is it? I'm seeing some green elsewhere.
No, it's not leaving the casino. It's just moving to a different table. We're calling this the boredom rotation.
Boredom. Investors are bored with Bitcoin going sideways.
In a way, yeah. I mean, Bitcoin consolidating at 88K is healthy, but it's boring for traders who need action. So they're chasing volatility, what we call beta in the alts. Mainly Ethereum and Solana.
And the data supports that. I'm looking at the flows. ETH ETF saw over 28 million in inflows yesterday, mostly into BlackRock's fund.
And Solana ETFs pulled in about 6.7 million. So you see the pattern. Sell Bitcoin, buy ETH and SOL.
Makes sense. It's the catch-up trade.
It is. But, and there is always a but, this structure is fragile. We need to talk about the leverage in Ethereum.
What's the risk there? Is it getting overextended?
The estimated leverage ratio for ETH on the derivatives exchanges, it's near record highs. That means you have a lot of people betting with borrowed money that ETH is going to rocket up. We call this a glass cannon build.
A glass cannon, high damage, but very fragile.
Exactly. It packs a punch on the way up, but if it takes one hit, it just shatters. If Bitcoin drops because of shutdown news, ETH acts like a leveraged proxy. All that high leverage could trigger a liquidation cascade.
And a liquidation cascade is when prices fall, forcing sales, which makes prices fall even more.
It's a domino effect. So while the ETH inflows look good on paper, the whole thing is built on a pretty shaky foundation of borrowed money.
Okay, let's pivot to the thing that could kick off that drop. Washington. The fiscal trap, government shutdown, midnight tomorrow.
And this time, it's not just the usual political theater.
Right, we always hear, they'll fix it at the last minute. We're kind of conditioned to ignore it. But the briefing calls this a procedural trap. What makes this time different?
It comes down to the calendar. The House of Representatives is literally in recess. They are gone. They aren't scheduled to be back in D.C. until February 2nd.
Wait, so even if the Senate manages to pass a fix?
There's nobody there to vote on it in the House. The lights are off.
Yeah.
Unless they do an emergency recall, which takes time and consent they don't have, they physically cannot pass a bill before the deadline.
That seems unbelievably dysfunctional.
It is. And the political gap is getting wider, not smaller. This all comes back to that incident in Minneapolis, the shooting of Alex Sprague.
Right, that was the catalyst.
It's totally polarized the negotiations.
Yeah.
Senate Democrats under Schumer have issued these red line demands for DHS funding.
Yeah.
They want an end to roving ICE patrols, mandatory body cams. Real operational changes.
And what are Republicans saying?
John Thune basically said no. They refused to sever the DHS funding for the main spending bill. So you have an immovable object and an unstoppable force, and one half of Congress isn't even in the building.
So if the shutdown happens, what's the immediate impact?
An immediate liquidity air pocket. Federal contracts just pause. That's billions of dollars that stop flowing. And you get the data blackout we mentioned, it just creates a vacuum.
And the market has to handle it on its own this time.
Correct, which
Yeah.
is why the fast money is heading for the exits.
Okay, but in all this chaos, there are some surprising winners. Let's talk about Tether.
This is a fascinating bit of corporate forensics. While everyone's worrying about the shutdown, gold has quietly blown past $5,300 an ounce.
A historic run. It's gone parabolic.
And who is one of the biggest holders of gold right now? Tether.
The stablecoin issuer, the USDT guys.
They hold massive gold reserves, both for their own gold token and as surplus backing for USDT. The estimate in the dossier is that Tether is sitting on about $5 billion in unrealized profits from gold alone.
$5 billion. That is a massive cushion.
It's a countercyclical buffer. Think about it. If the macro situation gets worse and the government shuts down, gold probably goes up. That strengthens Tether's balance sheet at the exact moment the crypto market might be getting shaky.
So it makes their USDT peg incredibly stable.
It does. It basically makes them solvency-proof against a short-term market crisis. They have a $5 billion profit buffer just sitting there.
Now, on the flip side, we have the miners, specifically CleanSpark. The narrative and the actions here just don't line up.
Yeah, this is a big warning sign. CleanSpark has been pushing this AI pivot narrative really hard. Buying land, talking up their new computing centers.
The whole, we're not just miners, we're an AI company pitch. But the insiders don't seem to be buying it.
No. We're seeing significant insider selling. Directors Amanda Cavallari and Thomas Laywood. They're selling heavily right into this news.
Selling the news. A classic.
And their earnings are coming up, expected to show a loss. It just suggests a lack of internal conviction. If the AI pivot was really about to print money, why would you be selling now?
Right.
It's a signal that the AI premium on these mining stocks might be getting a little overheated.
So be careful there. But a quick mention of Metaplanet in Japan. They're doing something totally different.
The dividend defense? I love this. They're paying a dividend to shareholders even though they have paper losses on their Bitcoin.
That's bold.
They're trying to prove their operating cash flow is real no matter what the Bitcoin price is. It's a smart way to prove they're a real business, not just a proxy.
Okay, looking at the clock, we have a huge event happening today, 2:00 p.m. Eastern.
The Harmonization Summit.
Yeah.
The SEC and CFTC are meeting.
The fireside chat. What are we actually looking for here?
Definitions. The Holy Grail is a clear definition of what constitutes a digital commodity.
And why is that the Holy Grail?
Because if they can clearly separate some of these assets from securities law, it removes that huge regulatory cloud. It lets institutions build without worrying about a lawsuit down the line.
It could be the one thing that decouples crypto from all this macro gloom.
It could, but it's a binary event. If they just say nothing, the market will shrug. We have to watch the wires.
All right, let's wrap it up with the technicals. We're sitting just below $90,000.
We failed the breakout. The market tried to push through 90K before the Fed, but it got rejected hard.
So what's the line in the sand? Where do we need to hold?
$87,000. That's the critical support floor. That's where Fidelity and the spot buyers are defending.
And if we lose it?
If we break 87K with any real volume, the next big liquidity pool isn't until around 84,000. There's an air gap below.
So 87K is the trench line. Hold it, or we could drop fast.
It is. We're in what you'd call defensive navigation mode. The Fed stepped back, Congress is stuck, ETFs are split. This is not the time for heroics with leverage.
Defensive navigation. I like that. So, to recap, Powell says no bailout, shutdown looks inevitable, Tether is sitting on a literal gold mine, and we are watching 87K like a hawk.
That's the state of play.
Okay, before we go, leave us with one last thought, something to chew on today.
All right, think about this irony. You've got the U.S. government facing a shutdown, can't pay its bills, and its central bank is admitting it's about to be flying blind without data. It looks fragile.
It looks very fragile.
Meanwhile, you have Tether, a private digital dollar issuer backed by billions in gold, a sovereign asset hitting all-time highs. They have a $5 billion surplus.
Okay, where are you going with this?
It just raises a provocative question. In the short term, is the private stablecoin issuer backed by a real-world sovereign asset actually becoming more robust than the sovereign government is trying to mimic?
Wow.
If the Fed won't provide liquidity, but Tether's gold reserves provide this huge buffer, who's actually the safer haven in a crisis?
That is a wild thought. A stablecoin issuer with a better balance sheet than Uncle Sam?
Welcome to 2026.
Indeed. All right, keep your eyes on 87,000, watch for those shutdown headlines, and we will catch you on the next deep dive.
Stay sharp, everyone.